Well, good morning, everyone. I'm Jim Mosquera. My company, Sentinel Consulting. What I do is I help businesses find money. And when you start out a business, that's probably one of the most important things that you're going to need to have is money to start the business. The other thing I do is not only do I find financing for businesses, but I also find financing for their businesses' customers. So consumer financing as well. There are businesses that have been shown to increase their revenue potential significantly by having a consumer finance plan. The other thing I do, I publish several books on finance, the economy, stock market, investments, and things of that nature. So it kind of works very synergistically with what I do. I titled this slide, "You Want to Borrow Money?" And so I'm going to ask maybe a question to somebody in the audience here. Has anybody ever borrowed money from somebody, family or friend? Yes. All right, I'll ask you. You don't have to get into details, but when you borrowed money, you borrowed from a family member or a friend?
Yeah.
Yes, family. What were the terms of the agreement of the loan, I guess?
I don't know, it's kind of loose just to make sure, I'm paying them back.
Did you have to pay back with interest?
No.
No? And this person knew you pretty well?
Yes.
Okay. Now let's take the converse of that. Has anyone in this audience ever loaned somebody money to a family or friend? Yes, I see a gentleman shaking his head. Tell me about your experience about loaning money to a family or friend.
I don't do it anymore.
You had a bad experience with it, okay? Anybody else loan money to a family or friend? Megan, you want to share?
Yeah, it's not fun.
It's not
fun? Like you said, on one end of it, when you do it, you have all the promises of paying it back, and most people don't have a plan of screwing someone over.
Okay.
But
when you engaged in that transaction with this family or friend or whatever, did they have to pay back with interest?
No, they tried to make sure it came back.
It came back, okay. And so when you made that loan, you had some notion that you were going to get paid back, right? I mean, otherwise you wouldn't have done it. We don't know each other, right? I mean, we've seen each other probably in a couple of these presentations. If I came up to you and said, Rhea, I need $5,000, and let's say you had $5,000, okay? I mean, would you loan me the money? And if you would, what sort of questions would you ask me?
I would want to, but I guess I would ask.
I mean, you're just not going to just loan me $5,000 just like that. So what sort of questions would you want to ask me? Since you don't really know me, right? We don't really know each other, so what would you ask me?
How much money do you make a month?
How much money do you make a month?
Pay me back,
Okay.
and how long have you been working?
Okay. Anybody else? What other questions would you ask me if I came to you? Jaime, what about you? What would you ask me if I came to you and you had $5,000 burning a hole in your pocket and you thought, hey, here's an opportunity to make some money by loaning out? What sort of questions would you ask me?
I don't know. I've never really loaned anybody money before.
Okay. And the gentleman in the back, what was your name, sir?
Jeremiah.
Jeremiah, you had a really, really bad experience with it. Okay. So with that as the backdrop, right? We've been on the receiving end of loans and we've been on the giving end of loans. Let's look at this is what I call my money wheel. When people want to borrow money, and let's take the context right now being the banking industry, because most people, when they think about borrowing money, they're going to think about borrowing from a bank first, probably. And we'll talk about some other avenues. When you go into a bank, this is what you see. A lot of Benjis, right, spinning around, and you have a different view of what you want to do than the banker. You want to know what the banker sees?
Right.
Right?
Sorry.
And there's a reason for that, and what that gets into is what I'll call the tug of war between you and the lender, okay? The attitude towards risk is probably the very first thing that comes to mind for a lender. And when you and I were talking, you wanted to ask me some questions about, okay, this and that, and how much money do you need, how much money do you make? An entrepreneur, because you've had this young lady here telling you about the entrepreneur mindset, the entrepreneur is very, very much a risk taker, right? You wouldn't be taking the plunge into your own business unless you were a risk taker. Well, the lender doesn't see it that way. The lender actually sees the opposite. They want to avoid risk, okay? And part of the reason that they avoid risk is because they have other people's money. They have my money. They have Marcel's money. They have Megan's money. They have Desi's money. right? Everybody here probably has some money in a bank, either through a business account or a personal account. So one of the things, perhaps the most important thing that a banker has to do is he has to avoid risk, or she has to avoid risk. And there's some historical reasons for that. Worldview. Again, entrepreneur, very optimistic. You only focus on the upside, anything that can go right. Lender, he focuses or she focuses on, well, what could possibly go wrong? Right? Jeremiah, when you made that loan, you were probably only thinking, you weren't thinking like a lender because that's not the business you're in, but you thought, okay, whoever I'm loaning this money to, there's upside there. Maybe you did charge interest, maybe you didn't. You had a pretty good feeling you were going to get paid back, and it didn't turn out that way. Lender, again, focuses on the downside. Education and training. The people that are normally entrepreneurs are involved in production and sales. The things that Jenny talked to you about today, they're sales related, right? They're sales promotion related. Production, right? You guys are going to cut hair. That's production. Lenders, their background is usually accounting and finance. They're numbers people, right? That's what they're looking at. Regulatory background. When you open up your own shop, I would assume there's some regulation you have to have, your certificate, licensing, and so forth. Lenders, two very important things that happened in this country that changed the lending environment significantly. Number one was 9/11. Number two was the 2008 financial crisis. When those two things happened, an already very regulated industry, banking, became significantly more regulated. Okay? So because of all that, you have this tug of war. You can see here, here's what a lender thinks about, and here's what their priorities are, and here's what your priorities are. So they're very, very different. And that's very, very important to understand, and the reason I'm spending time on that is because one of the things that I've noticed with entrepreneurs when they get into the point where they need to finance is they make certain assumptions about the amount of money that they can borrow that are completely unrealistic, okay? And that's partially because they don't understand this side. So I'm just giving you an impression of what this side thinks about when you need to borrow money. Preparation. The business plan. Jenny mentioned something earlier I think was really, really important about you have to be flexible, right? The business plan is one of the things that the more money you want to borrow, the more important it is to have a really well thought out business plan. Okay, there are some loans that I can sponsor. Do you need a business plan? No, not at all. But there are others, again, you want more money, you have higher ambitions. That banker, remember, the lender, they're risk averse and so forth, they want to see your plan. They want to know what you're going to do. However, that business plan also has to have some flexibility within it. And one of the reasons that I tell people to have a business plan is not even just to go borrow money, but the other aspect of it is that could be your management tool. You basically will manage according to the business plan. But as Jenny said, you may have something come up along the way. You've got this thing written in stone in your business plan. No, got to change that, right? I need to do something else. I had something within my own business plan that I had to kind of recalibrate my business a little bit. I mentioned consumer financing earlier. When I first started out 5 years ago, I didn't even think about doing consumer financing. But then more and more small business owners like yourselves, future business owners would say, hey, you know what, it'd be nice if my consumers, my customers had a finance plan that they could pay me because of the same reason. You as a business owner don't want to be a bank, right? And I can give you an example of an automobile repair shop here in St. Charles that did the same thing that you did, Jeremiah. That somebody brought in their car. Oh yeah, I'll pay you. I'll just put me on a payment plan. The car got repossessed. Okay, so it's the same concept. In consumer financing is they want to make sure that they're not a bank. So the business plan is very important. Again, from a management perspective and also from a financing perspective. The budget. A budget is part of the business plan. If you don't have a business plan, absolutely have the budget. The reason the budget is so important is because you will lay out meticulously, month by month, take it out a year, maybe 2 years. Again, depending on how much money you want to borrow, you may have to take out in the three-year budget and show, hey, here's how much money I think I'm going to make month 1, month 2, month 3, month 4, etc. Here's my expenses, right? And you need to manage against that because as you progress through your business life, particularly that first year, if you're not meeting your budget, it may tell you, it's like a dashboard, it tells you something's wrong, okay? And the reason I think the budget is even more important even than beyond trying to acquire financing is the third bullet point, which is exit. What do I mean by exit? At what point in your business will you decide, you know what, this isn't working, I need to try something else? That's very, very important, because I have seen a number of businesses that probably shouldn't be in business any longer. So what they do is they think, okay, I'm going to try to expand to grow my business when they're still not even profitable. That's a problem. It's a problem for borrowing money, it's a problem for you as a business owner. So one of the things that you need to do with that third bullet point is, it's the old Kenny Rogers song, know when to hold up, know when to fold up. Sometimes it's not going to work. So you need to be realistic about it. And when Marcel mentioned earlier, who's going to be on your business team? You have an accountant, an attorney, and so forth. Those are the people that are going to be in your corner to tell you, hey, you know what? Maybe it's time to stop this business and no longer make it a concern. Credit building. One of the things that you're going to absolutely have to have when you borrow money from anybody, regardless of the source, is you need to make sure that you have a good credit score. Now, can you borrow money even if your credit score is, say, in the 500s? Yes. Is it going to be more expensive than your credit score is in the 700s? Yes, it is. So keep that in mind. How do you build credit? Number one, make sure that your own personal credit is in good shape. If it's not in good shape, that's going to affect your ability to not just borrow money, but borrow money at good rates. The other aspect is when you build credit, when you set up your shop, I would imagine that you're going to order supplies. I guess you need more supplies. Maybe you have equipment, shares, and so forth. When you do that, make sure that you establish trade terms, credit terms with whoever the supplier is. You pay them on time, and more importantly, that they report everything to the credit agency. Because if they don't report things to the credit reporting bureaus, then it's like the rest of the world doesn't know that you're a good credit risk. And when we talked earlier, I said, would you loan me money? Well, one of the things that you'd said was you want to know what my credit score is, right? But if the agencies or the people that I'm paying aren't reporting to the credit reporting bureaus, then nobody really knows whether you're a good credit risk or not. There's two things that come into play with business loans, and that's business factors and personal factors. And let's get into each one. Collateral. A bank or somebody else, when they're going to loan you money, the collateral is, if you think about it from a home mortgage perspective, when you borrow money for a home, the collateral is the home, okay? When you borrow money for a business, the collateral is maybe the assets of that business. If you open up a shop, you're probably going to go into some lease space. You're going to have a small number of assets, maybe your chairs, your equipment, and so forth. If you borrow money for that purpose, your collateral is actually very, very small because you don't really own a lot of things. And so when a bank or some other institution loans you money, they don't want this. They want you to pay your loan off. They do not want that. Because if they have to get that from you to make them whole for the loan, they're going to value, how much does a chair cost, like a nice barber chair?
Like so much.
How much? $700 or $900.
Yeah.
Well, a bank is going to value that at about 10 to 15% of that, because they have to go get it and they have to try to figure out how to sell it. So their value of collateral, particularly in the business that you're going to be in, is not the same as what you think it is. So that's really, really important. Cash flow. Are you making money? Can you service the loan? Financial strength. Very, very important that once you start the process of contemplating borrowing money, that you keep good financial records. If you don't have good financial records, it's very, very hard to show cash flow. It might be very difficult to show collateral, and it makes it makes that risk-averse lender that we talked about, in that one slide, that tug of war, it makes them even more leery about engaging with you. Personal factors, we talked about credit score. Very, very important. There's no loan product that I can think of right now where someone isn't being asked for a credit score, okay? Anything that I work on right now, that's generally one of the first questions that get asked. Because that's a reflection on you and your ability as a credit risk. Skin in the game. There was an example I have, without getting into particulars, a business that had success online selling antiques, okay? The proprietor of this business now wanted to go online. Excuse me, they had it online and they wanted now to open a retail establishment. And so we were having the conversation about, okay, how much you think you're going to need, et cetera, et cetera. And then I asked the question, well, how much are you contributing to this? And the answer was, well, nothing. So then I said, well, so you expect then, and this is a brand new business now, so, right? Because the retail, the brick and mortar store is going to be new. So you expect the lender then to have 100% risk? Yes. So well, that's not going to work. Okay. So that's what I call skin in the game. If you're going to be requesting funds, particularly even on a startup basis, and we'll talk about SBA loans, the lender is going to expect you to have some skin in the game. Again, part of that risk tug of war, that slide earlier. Insurance. If you are absolutely key to your business and something happens to you, whether that's disability or God help us death, what happens to that loan if something happens to you? Well, the lender, again, the higher the amounts, the more important it is to have it. So the lender is going to want to make sure that you have some insurance. Think about like for somebody that owns a home, if you have an open mortgage with a mortgage lender, you have to have this, right? Because if something happens to the house, it's the same concept. Here's some different financing types. Friends and family is real common. We talked about that earlier. That was the first question I asked, has anybody ever borrowed money and so forth. Bootstrapping, that would be something that you yourself have saved money. Lines of credit, one of the things that I can do in my business, particularly for young businesses maybe that are less than 6 months old, we're able to find them lines of credit, which again, pools of money that are available to you to borrow that you don't necessarily have to borrow. It's a line that's available for you. Invoice PO factoring, something that will not apply to your business, but imagine that you were producing some sort of widget, okay? And I go and I have this widget and Jenny's company wants to buy this widget from me. But I haven't produced the widget yet. But Jenny says, okay, I'm willing to pay you $100,000 for these widgets. Now I say, oh, I need to produce that widget, but I don't have the funds to do that. And that's where purchase order factoring comes into play, which is I can show someone, a lender, a factor, that, hey, Jenny's got this great company, she's a great credit risk, and she's going to buy $100,000 of goods from me. And then that factoring company says, okay, great, Jim, I'm going to give you $80,000 for now. Okay. Invoice factoring is the same thing in that now I've produced the widget, okay, I've shipped it to Jenny, but Jenny's got this company way over in Germany, and sometimes it takes her a long time to pay me because she uses the widgets for some other productive process, and so I might not get paid for 90 days. Well, I mean, I've got Marcel on the payroll, I've got Jaime on the payroll, I got to pay them, I got my rent, I got all this other stuff. So that's the same concept where you get paid ahead of time, if you will, for money that you don't have yet, because they think Jenny's company is a good credit risk. SBA loans, that's where you can borrow money from banks with a government guarantee of anywhere between 5 and 90%. As you would imagine, when you're dealing with the federal government, is there a lot of paperwork involved? Absolutely. Does it take a long time? Absolutely. And then bank loan is what we were talking about initially. When you move down this spectrum here like this, think about it requiring more documentation on your part and having to answer many, many more questions. Here, in invoice and PO factoring, maybe even your credit score isn't as important. Her credit score is more important in that case. As you move down this continuum this way, more requirements on you, more documentation.